Well, behavioral, in our term, behavioral economics is different than behavioral finance because behavioral economics is really driven around what do people do. We're really more interested in what a customer is going to do at the beginning of the quarter, right? Are they going to buy the product? That's really more important to how people are going to overreact to an earnings announcement at the end of the quarter. So when we look at behavioral economics, it's really driven by the principle that human behavior drives consumption. And we want to find out what people are going to do and focus. We'll do our due diligence on the consumer before we'll do the due diligence on the company. It's really important. You see, 70% of US GDP is consumption. And so I got a real basic question. If I can tell you what 100 million people are going to do before they do it, do you think we can make some money? It's really very simple. You see, human beings are built in a certain way. There's some great research done back in 1943 by a guy named Abraham Maslow. Anybody who's taken a psychology course in college knows this. They look at Maslow's hierarchy of needs. And it basically says 6,000 years of human history say you're going to do things in a very specific way. You're going to fulfill your physiological needs, your needs for safety and security, your needs for love and belonging, your needs for self-esteem, and then self-actualization. And you're going to do it in that order. Without exception. Doesn't matter your race, doesn't matter your gender, doesn't matter where you were raised. If you're a Homo sapien, that's how your brain works. And so it's like this. If I put a plastic bag over your head, you don't know you're starving. You know you have to breathe. Take the bag off your head, then you know you're thirsty, and then you know you're starving. So these rules of behavior follow economic activity all the way through. And so you're going to first try to make sure you can eat, and then you're going to do safety and security and love and belonging and then self-esteem. How many times have you seen somebody sacrifice their self-esteem in order to fulfill their need for love and belonging? So it's what we as human beings do. And so if you understand that, then you can tell what a consumer's going to do before they do it and own the companies that they're going to buy things from. When we look at this fact of incomes increase, spending follows the same pattern. If you go back to Maslow, it's about 75% of the growth goes into physiological and safety and security, and the 25% goes into the rest. So one of the things where we see is that, why does someone buy a 13-year-old a cell phone? So I can call you daddy. So I will be safe, daddy. So all of those things. So now you've got the utilization of growing communications. So we look at that. That's why Verizon and AT&T have become so dominant. Or when we talk about love and belonging, why was Facebook so successful? Because everybody wants to be liked. So the choke point is really important. That's kind of a military term, but the point of the matter is it's that moment in time where the behavior is headed towards this place where everybody's got to go through it. It's kind of like a toll road. So everyone has to kind of be at that place to get to from where they want to be, the demand, to have the satisfaction of it. So you want to be the company at the toll gate. You want to be the best company at the toll gate because then you're going to that's going to drive pricing power. You've got pricing power. That's going to drive excess earnings, and excess earnings is going to transfer into performance. So it's like we said, I don't necessarily care whether it's Sprint, AT&T, Verizon, any of the others. I want to be the tower on the hilltop that everybody has to rent from for their networks to work. Or, we've never really worried about who won cola wars. Coke, Pepsi, I don't care. I want to be the lining inside the can that both of them have to buy so the drink does not taste like aluminum. So you can look at those kind of things, and that's what works to us in this process. Well, going into the rest of the year, it's been really interesting in that the markets, 30% of the market days in the last year have been moves of 1% or more in one direction or the other. So we're bouncing around with a tremendous amount of volatility. It's frequency volatility, and then you have these moments where you have these large checkdowns. We've had where the market goes down 11% in 15 days and takes 58 days to recover. So we actually think once we've identified the companies by our process of going through. You know, where are a lot of consumers going to be? Consumer behavior is not going to necessarily change from market behavior, but the pricing might. So we kind of say that cash flow trumps volatility. And we tend to hold a fair amount of cash in our portfolios because what we want to do is keep calm and buy on dips. And so when the market throws this volatility at us, that's a buying opportunity. So we hold lots of cash, we then take advantage of it, and we're able to pick up companies that a lot of people are buying a lot of things from at a discount. I mean, we like to buy things when it's on sale.